47.5% gone in a single weekend. And the most terrifying part, it was completely legal. March 16, 2013. Cyprus. A restaurant owner named Andreas walks to an ATM to withdraw cash for groceries. The screen reads, "Service unavailable." He tries another machine, then another. By noon, every ATM in the country is offline. Andreas has 340,000 euros in his account. Money from selling his father's house, savings for his daughter's education, his retirement buffer. By Monday morning, 160,000 euros of that will no longer exist as cash. It wasn't stolen. It wasn't hacked. It was converted under emergency banking law. 10 years later, in California, a startup founder named John watches his bank collapse in real time on his phone. He has $4.2 million sitting in his business account. Nearly all of it exceeds the FDIC insurance limit. The bank fails on a Friday. Panic spreads across the tech sector. But by Monday morning, John has access to every single dollar. Same exposure structure, funds far above insurance thresholds, two modern financial systems. Completely different outcomes. The difference wasn't the insurance limit. It was something most depositors never see in the fine print. Something that determines who keeps their money and who doesn't. That mechanism appears at minute 4. In 2013, Cyprus's two largest banks, Bank of Cyprus and Laiki Bank, were heavily exposed to Greek sovereign debt. When Greece restructured its bonds, those assets collapsed in value. The bank's capital buffers evaporated. Cyprus needed external assistance. The European Union agreed to provide 10 billion euros in rescue funds, but with a strict condition. The banks would be recapitalized internally first. That meant shareholders would be wiped out. Bondholders would absorb losses, and, if necessary, uninsured depositors would contribute. This mechanism is called a bail-in. Unlike a bailout, which injects taxpayer money from the outside, a bail-in forces losses onto the bank's internal creditors in a defined order. And here is the critical point. Most depositors never fully internalize. When you deposit money into a bank, you become an unsecured creditor. Legally, the bank owes you that money. It is a liability on their balance sheet. It is look at the bank become the bank. It is a light on their balance sheet. Then it is a light by bank internally. It is not segregated property sitting in a vault. At Laiki Bank, deposits above 100,000 euros were transferred into a liquidation structure. At Bank of Cyprus, 47.5% of uninsured deposits were converted into equity. Andreas lost 160,000 euros in 72 hours. Courts later upheld the action, ruling that systemic stability overrode individual claims. That decision set the modern template. When a bank fails, losses are not random. They follow a hierarchy. And here is what makes that hierarchy dangerous. Most depositors don't even realize they are in it. Shareholders absorb losses first, then subordinated bondholders, then senior debt. If those layers are insufficient, uninsured depositors become part of the loss-absorbing structure. Insured deposits remain protected under statutory guarantee schemes. $250,000 in the United States, 100,000 euros in the European Union. The purpose of this hierarchy is to prevent taxpayer-funded rescues by allocating losses internally. In theory, this reduces moral hazard and forces market discipline. In practice, it means that large deposits are positioned within the capital stack, not outside of it. And once regulators formalized bail-in frameworks after 2008, they gained confidence in allowing banks to fail, because the loss pathway was predefined. But that still doesn't explain why Andreas lost money and John didn't. In March 2023, Silicon Valley Bank collapsed with over $200 billion in assets. Nearly 90% of its deposits exceeded the FDIC insurance cap. 2 days later, Signature Bank failed. Weeks later, First Republic Bank followed, after sustained deposit flight. On paper, uninsured depositors at these institutions were exposed under the same hierarchy used in Cyprus. John's $4.2 million should have been at risk. Instead, regulators made a call. They decided that letting depositors lose money was more dangerous than protecting them. By Monday morning, all depositors at Silicon Valley Bank and Signature Bank had full access to their funds. Shareholders were wiped out. Certain bondholders absorbed losses. Management was removed. But depositors, even those with millions above insurance thresholds, were protected. The hierarchy didn't disappear, it was overridden. The reason wasn't generosity, it was contagion risk. Regulators judged that imposing losses on uninsured deposits could trigger panic across the regional banking system. John kept his money because his bank was considered systemically dangerous to let fail without protection. While regulators debated systemic risk in Washington, Andreas was still paying down the loss from a decision made in Brussels 10 years earlier. 18 months later, something changed. October 2024. First National Bank of Lindsay, Oklahoma. Total assets, $107 million. Uninsured deposits, $7 million. This time, there was no emergency meeting, no systemic risk exception, no protection beyond the statutory limit. Uninsured depositors received 50% immediately. The rest, dependent on liquidation, still pending. Same country, same year, different outcome. The only meaningful difference was scale. Here is the uncomfortable reality. The safest large deposit is not necessarily the one under the insurance cap. It is the one inside an institution whose failure would threaten the broader system enough to justify discretionary protection. That threshold is not fixed. It is assessed in real time. And that discretion is the hidden variable in modern bail-in architecture. 1 month ago, the pattern repeated. January 30th, 2026. Metropolitan Capital Bank and Trust in Chicago fails. Total assets, $261 million. This marks the first bank failure of 2026. And, like Lindsay before it, there is no systemic risk determination, no emergency exception. The resolution follows standard procedure. Most depositors are made whole, but the language is careful. Substantially all, not all. The distinction matters for those above insurance thresholds. The bank's failure was attributed to capital deficiencies, but the resolution mechanics were identical to Lindsay 18 months earlier. Metropolitan was roughly 2.4 times larger than Lindsay, still too small to trigger systemic concerns. Still resolved through standard procedures, the threshold remains invisible. But the pattern is clear. Banks below a certain scale do not receive emergency protection. The hierarchy applies as written. This is not a criticism of the system. It is how the system is designed to function. Smaller institutions fail through orderly resolution. Larger, systemically connected institutions may receive discretionary protection. But that discretion is the critical variable, and it is assessed in real time, under pressure, with incomplete information. Which is why understanding where your institution sits on that spectrum matters more than understanding the insurance limit alone. In March 2023, Credit Suisse faced imminent collapse. Swiss regulators brokered an emergency acquisition by UBS. To stabilize the transaction, $17 billion in additional Tier 1 bonds, instruments designed specifically to absorb losses, were written down to zero overnight. Shareholders received merger consideration in UBS stock. Under traditional bankruptcy logic, bondholders rank senior to shareholders. Yet in this case, bondholders were wiped out while shareholders retained value. Authorities defended the move under contractual triggers and emergency powers. The message was clear. Hierarchy exists, but emergency discretion can alter how it is applied. Modern resolution frameworks are now embedded across developed economies. They are designed to execute quickly, often over a single weekend, to prevent panic and allow markets to reopen with clarity. Major banks maintain living wills, outlining exactly how losses would be allocated. Capital buffers and bail-inable debt instruments are pre-positioned to absorb stress. Most of the time, these safeguards work. Deposits function normally. Insurance schemes provide stability. Capital requirements create resilience. But in rare moments of acute stress, the position of your deposit in the hierarchy and the regulator's assessment of systemic risk determines the outcome. So, what does this structure mean in practical terms? It means that deposits above insurance limits are not simply at risk in an abstract sense. They are positioned within a legally defined hierarchy. Here are the variables that matter. Institutional scale. Larger institutions are more likely to be deemed systemically important. Smaller community banks typically resolve through standard procedures. The threshold is not public. Interconnectedness. Banks linked to other institutions receive systemic risk consideration. Standalone institutions do not. Timing and context. A failure during a period of broader stress is far more dangerous. These variables are not disclosed in advance. They emerge during crisis decision-making. So, how do you protect yourself? First, diversification. Keep balances under insurance limits across multiple institutions. Second, ownership categories. Structuring accounts can effectively multiply your coverage. And third, monitoring. Watch the early signals. Equity prices, credit default swap spreads. In fast-moving situations, the window can close in hours. But here is the harder reality. You cannot eliminate discretion from the equation. You can reduce your reliance on it. You can avoid the worst-case scenario, but you cannot control whether your institution receives protection. Understand this. Deposits above insurance limits are not held in a vault. They are unsecured claims within a capital structure. Andreas in Cyprus learned this in 2013. John in California was shielded from it in 2023. Lindsay and Metropolitan depositors experienced it just recently. The framework has not changed. The outcomes have varied based on discretionary assessment. And that discretion is the hidden variable in your deposit's actual position. Andreas in Cyprus held €340,000. He lost $160,000 because his deposits sat above the threshold, at a bank regulators believed could be resolved without threatening the system. The hierarchy was applied exactly as written. John in California held $4.2 million. He lost nothing, because his bank's failure was judged too destabilizing to allow depositor losses. The hierarchy existed, but it was paused in the name of systemic stability. Uninsured depositors in Oklahoma absorbed losses. No emergency override, no exception. Just the standard order of claims. 1 month ago, Chicago. The same pattern, standard procedure, no systemic risk determination. Credit Suisse bondholders lost $17 billion because emergency powers prioritized stabilization over traditional logic. 6 cases, multiple jurisdictions, same legal architecture. Deposits above insurance limits are not segregated property. They are structured claims inside a hierarchy designed to absorb losses when capital fails. Most of the time, that hierarchy feels invisible. But in rare moments of acute stress, losses don't disappear. They move. They move down a ladder. And where your money stands on that ladder determines what happens next. If this changed how you think about your deposits, send it to someone running payroll out of a single bank account.